morning. Welcome to Monday, 21st of September. Getting ever closer to the end of the month. Today we're talking global debt and its biggest jump ever. The BIS, or Bank for International Settlements, has released its global debt report, and Bank of America has summarised it. Whilst regular listeners shouldn't be surprised by the results, there are some remarkable movements and results, and Australia holds its unenviable second worst in the world crown. Trading Economics outlined worse to come for Australia. But first, from Bank of America. Global debt, or GDP, surged to an all-time high in Q1 2020, with overall debt for the non-financial sector now worth 252% of global GDP. This is up from 241% at the end of 2019, and the biggest quarterly jump ever, according to BIS data. Check out this next chart here. Check out that for a start. Very, very sharp increase there with the onset of COVID. The chart also confirms that central bank inflation targets are higher, much higher than the official 2% to erase this debt. Central banks needs inflation to be around the 10% range. Anything below that would require debt defaults, instead of inflation to wipe away the debt, and that is unacceptable. This increase reflects the fallout from the first few weeks of the COVID crisis, with most advanced economies implementing total or partial lockdowns in March. Hence, the historical contraction in GDP growth observed worldwide in Q2 and the debt surge from both governments and non-financial corporations will translate to an even bigger rise in the global leverage ratio in Q2 20. While this was the biggest jump in history, they say the drop in GDP in Q2 will make it worse again. They note too that EM giants of India and to a lesser extent South Africa will have late entries into the pandemic, and with the OECD expecting 10.2% and an 11.5% drops in GDP in Q3, the pain could well get worse into Q3. The ranking and breakup of the debt load is interesting to look at. Next, we'll show you something presented graphically and in a table. Your eyes might be drawn to the big yellow bar of Australia, or the red warning shading in the table. Second only to Switzerland, our personal debt is now an eye-watering 119.4% of GDP. We say now, as this is Q1 data. Since then, we've had our GDP, the denominator, fall sharply. In terms of the numerator, the amount of personal debt we hold, we have had, and the combination of mortgage holidays, in which no debt is paid down, and the government home buyer grants, sucking more people into the Aussie property Ponzi scheme, and hence increasing the amount of debt. Sucking is also a key word, as each and every one of these grants to prop up our beloved housing bubble is literally sucking forward future demand. In the past, immigration has filled that void. Immigration is gone for an indefinite period now. Throw in stagnant wages and underemployment, as we talked about recently, and it becomes a very, very worrying cocktail. Check out this chart here. Take a pause and zoom in on that one. Some very interesting breakdowns for each country there. And also this next chart here. Global debt versus GDP heat map. See if you can find Australia. Beyond that Q1 now, Trading Economics agree and quantify as follows. Households' debt to GDP in Australia is expected to be 124.5% of GDP by the end of this quarter, according to Trading Economics global macro models and analysts' expectations. Looking forward, we estimate households' debt to GDP in Australia to stand at 124.5% in 12 months' time. In the long term, the Australian household's debt to GDP is projected to trend around 125.8% of GDP in 2021 and 126.24% of GDP in 2022, according to our econometric models. In the past, Australia's total debt to GDP, despite always being first or second at the personal level, was contained by relatively low government debt. Our precious election-determining surplus countered all that personal debt. Since COVID and the deficit-funded government fiscal support has come with it, our green-shaded government debt in the table shown previously is under threat. The RBA is banging the table asking ScoMo to step up with more rather than leaving it all to them. JobKeeper just got extended, and of course the aforementioned property building grants, but they all want more. Our corporate debt, you will notice, already in yellow and speaks to the concerns about the insolvency wave to come, as no amounts of stimulus can solve a solvency crisis. Wow, that's a great wake-up call to start the week there for our Monday news. Maybe you can go to ainslieBullion.com.au for all of our gold and silver products, ainsleewealth.com.au for all our cryptocurrency products, and goldsilverstandard.com for our gold and silver backed cryptocurrency. We'll catch you tomorrow.